part of the challenge in the replication space is there are people who approach it as a statistical exercise. Having created systematic strategies for a long time, there's a science to it. There's the sort of statistical work that's done and computer science work that's done, but there's also an art to it.
Welcome to The Derivative by RCM Alternatives. Send it.
Hey there, this is Bob Elliott, co-founder and CEO of Unlimited, here to talk about hedge fund replication and how it might be beneficial for your portfolios, the Fed and monetary policy, and maybe a deep dive into the live cattle market at the end on The Derivative.
Hey, Bob, how are you?
Good. How are you doing?
Great, thanks. Where are you?
I am in what can look to be an undisclosed location, a very sparse office in a generic roadside office complex in central New Jersey, which is not where our main office is, but it's where I work sometimes.
Nice. And the main office is in New York?
Main office is in New York. Yep, downtown.
Love it. And what's your background? You've always been an East Coast guy?
Yeah, that's right. I grew up in Detroit and ventured to the East Coast to what I thought was the big city in Boston when I went to college, and have stuck around the East Coast, basically somewhere between Boston and Central Jersey through most of my my time. So I consider myself a Detroiter by heart, even though it has been, I guess, almost 20 years, more than 20 years since I've lived in Detroit.
But weren't you ragging me the other day that you're a Vikings fan, not a Lions fan?
No, not a Vikings fan. No.
Just a non-Bears fan. Got it.
Just giving you a hard time about being a Bears fan, which is only second to being a Lions fan for 30 years in terms of ignominy. So I fortunately had the benefit of my sort of primary football allegiance is the University of Michigan, having grown up there. My parents went to the University of Michigan. And so when I moved from Detroit to Boston for college was when this guy Tom Brady started playing for the Patriots, and so I had a few decades of Patriots allegiance, mostly due to my Michigan allegiance. Actually, those teams actually had a bunch of different Michigan players on them, but since he left, I guess I'm back to the Lions, who are a bit of a heartbreaker these days.
You guys took it to us last week. We had a good blog post years ago. We'll put it in the show notes with that picture of Brady from the draft. You know, that famous, he looks like a weakling, nobody. And then tied it into basically like, hey, so you might be looking at these different hedge funds and don't just throw a bunch of these away because the recent performance is no good. Like, actually understand what's going on and if they're winners or not. And then where was college? In Boston?
Harvard.
You're one of those guys. So I went to some small school in Harvard. I've heard of it. Awesome. And then there's something about botany in your bio. What was that all about?
No, my academic training is actually was in the pure sciences. I thought for a while that I was going to be doing botany for a career, and after months and months of being in the sixth basement of the biological laboratories, growing plants, all alone in the dark, I decided maybe I'd want to do something a little more interactive with people in my career.
That was before Matt Damon made it cool in The Martian, right?
Exactly.
I wonder if the botanist curve is spiked up after that. And then so decided to go into finance and ended up at another small place nobody's heard of.
That's right. Yeah. I mean, I actually part of my time in college, I spent working on public health issues, and sort of increasingly recognized sort of public health is connected with macroeconomic dynamics in a lot of instances. And so I went to Bridgewater kind of with the idea that they'd pay me pretty well to get like a master's in economics. I had not really had much in the way of any formal training. And, I went and really fell in love with the markets and the macroeconomy and now it's 20 years later, just like that.
What kind of public health, like COVID type pandemics, or was more of like everyone's too fat, or we're eating the wrong stuff, or a little bit of both?
Well, back then, probably the biggest global public health issue was the HIV and AIDS epidemic, and it was an interesting time where a lot of the therapies that could help stop both the transmission, reduce the transmission rate, and also prolong life were available in Western countries, but the predominant problem existed in the global South, and so a lot of my work was around how do you get folks in the global South to have access to it? And part of the challenge there was building enough of a national grassroots constituency that was supportive to that concept in order to put pressure on Congress and the president at the time. And sort of the peak of the success was building the grassroots constituency that helped get PEPFAR, which was Bush's AIDS treatment program, through Congress, which was the probably the biggest global public health success of the 21st century. Probably saved tens of millions of people's lives and extended tens of millions of others' lives. It's no longer in existence as of this administration.
Uh-oh. I thought that was Bono who did all that. That was you.
we for there's many rock stars who focus on lots of different things. So certainly his work was appreciated for sure. But it was not just him.
And then interesting to hear you call it the global South. That's basically sub-Saharan Africa, or you're saying even into Southern Asia and whatnot?
Yeah, at the time, places like Thailand, Latin American economies struggled with the HIV and AIDS epidemic, and so it's sort of a way. Emerging countries is more like a finance term than it is a public health term, and so there's other communicable diseases that particularly affect the global South. So it's more of a statement of public health geography than it is a statement of like economic geography or something like that.
Got it. And then what was it like to get the seat at Bridgewater? Were you one of thousands trying to get in there? Were they less known at the time? Like, was that a hard interview? Was that a hard job to get?
Yeah, I mean, it was interesting at the time. It really was an unknown, and so my college roommate interned there as a technologist and was like, I think you'd probably like these people and like the work, and the sort of core effort, basically the core edge there was looking for people from non-traditional backgrounds, whereas the big banks were hiring anyone with an economics major. They were really looking for non-traditional backgrounds, and the reality is pretty much everyone who was there, who started there out of college, was from something that was quantitative and rigorous, but not narrowly tied to economics. And the truth is, most of what you learn in school for economics is pretty useless when it comes to day-to-day trading of markets.
Friend of mine's at Peak Six here in Chicago, and they hire like poker pros and geologists, all sorts of weird stuff. Same concept. And that tells me my son's a junior in high school. Looking at the colleges, like, it's not necessarily where you go or what you're into, but that connection, right, of your roommate got you into.
Yeah. I mean, it's just that, and I think being curious and flexible, right? So, like, it's a question of whether you focus on learning skills or just interest and ways of thinking, and that matters in a 50-year career. being curious and having sort of the sort of picking up the certain aptitudes, let's say, rather than skills, meaning like, if you have a quantitative aptitude, your skills, like I just think about my career, like, we went from running regressions in Excel to like, building machine learning strategies. The world has changed a lot in 20 or 25 years, but the sort of setting the foundation of having those sort of aptitudes are the things that really matter.
And then, so somewhat you started on the ground level there and became like,
yeah, I actually started one seat from the mailroom. They used to leave the mailroom door open. It was in the basement, and they used to leave the mailroom door open, and even when it was very cold. So some days I had to wear gloves, and there was no natural light or anything like that. So I do like to say I started literally at the ground level as an analyst.
You left the basement of Botany for the basement of Bridgewater.
Yeah, exactly.
And then, but semi quickly, or how long? Eventually, you were kind of Ray's right hand man. Is that fair to say?
Yeah, relatively quickly. Started to work with him directly in after roughly a year, give or take, and that did a bunch of different interesting work, and it really sort of accelerated around the financial crisis, where as a sort of what was it, 24 years old or something like that, he turned to me, he looked at me, he says, this housing crisis, it was not the financial crisis, it was the housing crisis back then. Yeah. This housing issue, big deal or small deal? And so I had to quickly become an expert in banks, the housing market, product structuring, credit risk, and I came back to him and I said, I think this could be a big deal. And so that was a good call.
When was that? In 06, 07?
Yeah, I distinctly remember in the fall of 07, basically looking deeply at all the financial institutions and the credit risks and things like that. And basically in the fall of 07, it was pretty clear that every financial institution in America was going to be broke as a result of the credit risks associated with this, and and with the housing market. And of course, a lot of those institutions were super highly levered at the time, right? So you looked at a bank, right? It was at many of them on a sort of true capital basis were 30 times levered. So it's not like you had to lose that much to be broke, but it became pretty clear even at that point that that's where we were headed.
And then, were you guys looking at it two ways, right? Of like, hey, also these are our primes and custodians, and right, like, yes, not only is it market moving, but we have risk on the other side of the equation too.
Yes, for sure. When you run money, the credit risk of your counterparties matters a lot. And well, I won't talk too much about anything in specific. Yeah. What the thing that really broke Lehman was not really the credit risk that they were holding, but basically as their CDS spread widened, basically everyone cut them off from business and forced more collateral. And so that, it highlights that for any financial,
highly reliant on overnight repos and everything.
Exactly. And that for any financial institution, the thing that really, liquidity matters more than creditworthiness, because creditworthiness you can deal with, meaning like you can paper it over, you can extend it and pretend, you can do all sorts of, there's lots of nonsense that you can do to deal with creditworthiness. But if you run into a liquidity problem, you're dead. And so that was
the Silicon Valley Bank for a reason.
Exactly. A perfect example, a bank that, basically is totally fine. If anything, actually, the folks who bought it got a steal for it, because the credit and the business relationships were pretty good.
And so all these thoughts of yours are making it into the daily observations, the famous fax. Was it still fax, or was it getting emailed? What was happening?
It did actually. When I started, there were still faxing. I got very good at working the fax machine. many years ago. But yeah, you're right. You're right. It was sort of known on the street as something that got faxed to everyone. There was a whole production of faxing it to folks, which was fun. But yes, I was writing the daily observations pretty regularly. I mean, over the course of almost 15 years, I wrote hundreds and hundreds of those daily observations. So
Pre-AI, you like actually had to hammer it out.
you actually had to type, and still even today, in my Substack, or Twitter content or Substack, people are like, "Well, where are all the analysts helping you or whatever? Who helps you, or do you use AI or things like that?" And I'm like, "Nope, I just write." I know it's a little.
Right here.
Yeah, this guy, right? Who does all the work? Me. I know it's a little analog, but it's how I learned how to process what's going on in markets, and so that's what I do to this day.
Mm. And was your name on those? Were you getting credit for that?
Oh yeah,
yeah.
yeah.
All right, perfect. So before we leave Bridgewater, give me like known for their radical transparency. All that, was that just more PR, or was that actually happening? Was it weird? Was it cool?
Yeah, I mean, I think I like to sort of describe the place. There was a small group of people who were largely in a small building, who ran the money, and that group, operated like any high performing financial group, in the sense of people were straightforward and it was hard work, and you didn't pull any punches when it came to trying to figure out what was going on. But honestly, not that much different than most. If you went to most financial firms that were high performing, basically the same. And then there was like 2,000 people that were engaged in some sort of social experiment, which, like, I didn't see those people. I didn't engage with those people. I'd show up at the holiday party and I'd say, "Who the hell are all these people?" They just like were not a meaningful component of what the core part of the business was.
What were they doing? Who knows? Faxing each other.
Yeah, who knows? And honestly, the people who were running the money didn't have the time to worry about what all that other nonsense was. We were just focused on running the world's largest hedge fund at the time.
So one of those 2,000 couldn't come into your office and be like, "You're doing this all wrong, and here's how it should work." And like that is kind of the perception from what you read of like anyone could do anything.
Yeah, I think there were a lot of people outside of the core of the business who were doing those various activities, but the core of the business was, it was just, as I said, just basically normal. I mean, normal in the sense of, consistent with any high performing organization, which isn't necessarily right for everyone, but it is, if you've been in any of those seats, you know what it's like. If you worked at on a trading floor, you probably know what we're talking about.
I did, yeah.
Right.
Right. Normal for running $180 billion or whatever you guys
Exactly. Something in that order of magnitude.
Which always annoyed me. I was writing blog posts about managed futures. Barclay Hedge would report the managed futures AUM. It was like 380 billion. And I finally like dug into it, and 180 of it was Bridgewater.
Like, is that right? I didn't realize that. Yeah, it was like, before. Yeah, not real. That doesn't seem right. That's not. So that would
got in a big fight with Saul Waxman over there, and was like, "Hey, you got to take Bridgewater out." And he's like, "Well, we can't just take managed futures assets from 380 down to 200 overnight." It's like slow wind down of like pulling.
Oh, that's interesting.
Programs out. And,
yeah, that's interesting.
But I was like, I think would you have considered yourselves managed futures at the time?
No. Systematic global macro would have been the way I would have described it at the time.
You were using futures, but yeah.
Yeah, exactly. I mean, futures are just an exposure tool, but not, just a way to implement a view, but not and I think actually sometimes when I talk to people, they get sort of confused. There's natural confusion. I was actually talking to an advisor yesterday who asked a simple question like, "What's the difference between global macro, and managed futures?" It seems like it's the same positions that you're trading or the same markets that you're trading, and it really comes down to the way in which the views get constructed. So, like, let's say traditional sort of managed futures is really focused around price trends and movements pretty strictly, whereas global macro trades the same markets and may even look at price trends as part of their approach, but they're also looking at like concepts of value, intermarket action, what's priced in to the, when it comes to the economy relative to what's likely to happen with the macro economy, dynamics like that. What's going on with policy moves can shift what's going on with global macro views in a way that might, lead or not be reflected in price trends. So macro in some ways is like I'd say a more strategy diversified way of approaching the same markets than traditional trend following approaches.
I 100% agree. I also sometimes say like macro can be long, short, flat, whereas trends are going to be more long, short, and they're just going to take a position regardless of what's going on. Whereas a macro man or woman might say, "Hey, hold on, this looks scary, or this doesn't look risk worthy." Last bit, we'll dive into more of this stuff, but on Dalio, you got one or two words. Was he brilliant, quirky, eccentric, all the above? Like,
Well, I think I'd say when I started my career, he was it was great to work with him to develop a really good understanding of the macro economy and markets and the insight. I'd say the insight to systematize macro was a pretty unique insight at the time. It was sort of the time where if you sort of were in the macro milieu, you'd sort of say, oh, well, these are people taking huge concentrated bets in a discretionary way, trying to break the pound and stuff like that.
yeah,
And the insight,
yeah.
exactly, the insight to basically say, no, actually, a better way to run money is to have a 55-45, probability of being right and diversify over 100 markets or 120 markets. That was a smart way to manage money and a differentiated way to manage money. And so, I thought when I started my career, it was a great place to start my career. The other thing actually, which I think probably doesn't get enough credit in terms of building the business, which I'd still use today, is just the investment in communicating investment thinking clearly on a day-to-day basis to your clients and helping them to both help them understand what's going on and as part of a process of helping them manage way more, manage any single manager is going to be a tiny slice of any portfolio, right? And so how do you help managers manage the whole book? How do you help them A, sound smart to their either higher ups or clients, and B, how do you help them manage their whole book? A lot of the stickiness of the business was built around that sort of strategic partnership. Both the daily observations were essentially a tool in that regard, and the longer term strategic relationships beyond just whatever the return was important. So that's a lot of I still like that sort of ethos of how to build a business is, in many ways at the core of what we're doing at Unlimited and what I do on a day-to-day basis. And so I think that probably doesn't get, people talk about the running of the money, but that building of the business part probably doesn't get the credit that's due.
Yeah. Which it seems to me he kind of went too far that way in the last few years. He's promoting a book and doing all this stuff, but
yeah. I mean, I mostly focus on the for me the strengths of. It was a great place when I was starting my career. It was a fast growing. I mean, we went from being the challenger to the incumbent. Like, it was a great place to. It was a very interesting time in markets, and so you put all that together. It was a great foundation for a career for sure.
Yeah, and it definitely became the like you don't get fired for buying IBM kind of thing, right? To your point of like, hey, that was the result of all that work. All right, enough on those guys. You left for a reason. You hung your own shingle. So tell us about Unlimited?
Well, it's interesting in a lot of ways. Having sort of been in the 2 and 20 business for a long time, I sort of increasingly recognize some of the challenges of the 2 and 20 business, particularly, um, given the fact that two and 20 businesses are pretty good for the manager and not necessarily that great for the investor. And the reason why that is a couple of different reasons. I mean, the core reason why that is the fees are too high, meaning,
You gotta pay those
managers.
2,000 people.
Right, exactly. Managers that charge 2 and 20, it just doesn't make sense for particularly when you see strategies that are run at sort of bond like risk. The fees are too high, and so the manager, I like to say, hedge fund managers generate plenty of alpha. It's just they take it all for themselves, and their clients never see it. Um, and, on top of that, starting to think about whether there was, seeing that for a lot of folks, they're totally locked out of hedge fund strategies for a variety of different reasons. And so that got me to thinking with my co-founder, Bruce, about whether there was a way to bring sort of concepts of diversified low-cost indexing and bring it to the world of 2 and 20. And of course, to do that well, you can't invest directly in managers, right? You can't build fund of funds because you pay the managers and then pay yourself. And now we got too many fees. Fees were already a problem. It's even worse than that structure. And so our idea instead was to build technology, leveraging our experience having built these strategies, that looks over the shoulder of how managers are positioned in real time and then takes that understanding and uses it to hold long and short positions in liquid securities that can back things like ETFs. And if you put those strategies into an ETF wrapper, both not only does that open up the door for essentially any investor to have access to these sort of approaches, but because we're using technology to run it, we can offer it at a much lower fee point than what typically exists, and we can also target the return to be something away from not just institutional like returns, which is like cash plus a few hundred basis points. We can actually take the same understanding and target something like equity risk, which is much more cash efficient and a much higher return potential that's in a portfolio. And so that's the core of the business. We've been around for 3 years, and have over the course of that time proven out that our replication tech is working well. And in the recent period have launched some of these individual sub-strategy ETFs, meaning things like like global macro, managed futures, equity long short, but doing it at a 2x target return in a way that makes it a pretty what we think is a pretty compelling pairing in a lot of client portfolios.
And I love the name. What was the you guys sat in a room, sat at a bar, went through a list of 20?
Yeah, well, the idea naming is a real pain. That's what I would say.
Yeah. You find a great one, you're like, damn it, someone's got that.
Yeah, exactly. So we needed something that was that you could spell. So unlimited, right? You could spell easily, which was important. Something that wasn't already taken, and then also what it is it's a little bit of a play on limited partnerships. We're unlimited because anyone can invest, and then our U, which was designed here, you can see it in the background here. Has the up and to the right, that line that's up and to the right is reflective of what an ideal return profile looks like, that we're trying to help people go up and to the right.
And you couldn't very well try and disrupt 2 and 20 with like some fancy Greek word that all the 2 and 20 guys use, right?
Exactly. Like, yeah, we're not, there's always people trying to get 2 ways too clever. Like I need something that someone can spell,
And then interesting to me, you didn't, right, with your background, you didn't come in and say, hey, I know how to build these models. We're going to build the next great macro model based off my expertise and run it in an ETF, right? Like you could have easily done that as well. What was that decision of like, I think replication is better than my own ideas?
That's right. And I think part of having lived the experience of a individual manager is recognizing that any one manager, there are going to be times when it's doing well relative to the index, to their peers, and there's going to be times when you're not doing well relative to your peers. And I think in many ways, the world of allocators thinks that if they try hard enough, they can find the managers that do better than other managers over time. And the reality is quite compelling that there is no single manager outperformance persistence among a group of hedge fund peers. There's plenty of alpha generated by hedge funds, particularly gross of fees, but no one manager does particularly well. And I lived that life up and down around, through my time at Bridgewater. And if you take that as a reality, which there is no manager outperformance persistence, I should say beyond random chance, then the best way to approach running money, the best way to extract the alpha from hedge funds is actually to diversify and lower fees rather than try to either pick managers or do it yourself. And so that's sort of the core idea is, in some ways, the humility of saying, hey, look, I can generate alpha over time. But if you really want the best return that you can get, you actually don't want to pick me as an individual manager. You want to use the wisdom of the crowd and get a more consistent return.
And we've had Andrew Beer on the podcast before, who's doing replication on trend, and we dove into and interested your thoughts. But you need those other guys to stay in business in order to replicate them. So it's a weird concept of I'm trying to disrupt that and take all these assets, but also I need them to keep replicating. So it's a little weird of well, we're going to take some of your money. We're not going to take all your money. You need to stay in business.
Yeah. I mean, if you think about the hedge fund industry, there's $5 trillion of assets in hedge funds. If we got 1% of that, we would be one of the most successful, startup asset managers in the last couple of decades, so we're good.
Yeah. But if everyone's trying to do the same replication, right, then it becomes it's like a splinter in my mind a little bit of how do you square that of the thing you're trying to replicate needs to exist.
Well, I think if anything, actually, the benefit is that there's probably the evolution is actually beneficial over time, and in that sense, the reason why that is because what replication will do over time is it will knock out a bunch of marginal managers, meaning managers that don't really justify their 2 and 20 fees, and it will create selection towards managers that do justify 2 and 20 fees. And look, there's lots of reasons why you might want the 2 and 20 fee structure. You can tailor it. There's all sorts of things. If you're a institutional investor, some mandates only let you invest in fund structures, or you have to invest in individual managers. All sorts of institutional reasons why that is. And so my guess is that there's always going to be a demand for hedge fund strategies. It's just the people who should be worried are the people who are not worth their fees, right? And so that's what we're really going after.
And then for our wonky nerd listeners, you're doing top down or bottom up? I think per our discussion right here, you're doing top down.
Yeah, good. That's if someone knows the off the cuff the difference between the top down and the bottoms up, it's a framework that Corey Hoffstein highlighted, which I thought is frankly a helpful framework, which is this idea bottoms up, meaning in some ways is basically saying replicate the decision rules, right? Versus top down is replicate or infer the positions. And so predominantly, I say any replication is a little bit of a combination of both, because in some senses, even the selection of the exposures is a bit of a bottoms up concept, meaning for our replication, for each individual hedge fund strategy, we tailor the positions, the plausible positions based upon the style. So equity long short, is sectors, factors, size, geographies versus global macro, which is, global currency, commodity, fixed income, et cetera. So there's sort of a bottoms up part of it there through the selection of what the exposures are. But we predominantly focus on a top down approach. And the primary reason why that is at least in things like global macro, but really pretty much in any of these strategies, other than maybe managed futures, you there's a combination of discretionary, systematic thinking that goes into positioning at any point in time. And so you don't want to be too stuck in rules. It's like one of the reasons why a lot of that sort of smart beta or factor type stuff has been kind of mediocre, because like as something like carry is good in certain circumstances, it's bad in other circumstances, and sometimes it's irrelevant. Like if an administration is trying to impose a bunch of tariffs instantaneously on the economy, carry probably doesn't matter at all relative to whatever that dynamic is, or if there's a pandemic or all those sorts of things. And so we like to infer the top down. It also allows us to sort of follow on in terms of, as managers are getting better and better because they're constantly investing in capital to create more alpha, we're agnostic to that process because we're just following their positions. So if they find better and better sources of alpha, we're just following the positions and essentially following their evolution rather than getting stuck and trying to replicate their decision rules.
But you don't actually know their positions, right? So that's the machine learning and the technology of inferring, as you say. Okay, they made 6% last month. It's probably a high number. They made 0.6% last month.
Right.
That was likely due to these 20 long short equity positions, and you can run this regression analysis and basically find what position would have resulted in that return.
Yeah, so that's right. We're inferring the positions from the path of returns, and so the thing that is sort of core insight in terms of how we approach it is that positioning is continuous, meaning like hedge fund managers don't flip their positioning instantaneously. Any one hedge fund manager doesn't, because you take transactions costs, and certainly if you talk about 500 global macro managers, they're in aggregate not flipping their positions instantaneously. And so that actually gives you
got like that spaghetti chart, and you're looking for the middle of the chart there.
Yeah, I mean, that gives you that means, because positions are continuous, it means they're path dependent. And so there's actually a lot of information value in the path of returns, because the outcomes today are a function of today's positions. Today's positions are adjacent to yesterday's positions, and yesterday's positions can be seen through yesterday's returns. And there's only so many portfolios probabilistically that describe today's outcome, and an adjacent portfolio that describes yesterday's outcome. And then functionally what we do is say, and all the adjacent portfolios back for the last 25 years, all the way back up to today, what are all the portfolios probabilistically that are describing the returns? And so the good thing about that approach is it solves one of sort of the core problems of replication, which is most replications, sort of traditional replications, are using back histories, meaning using regression approaches where you have to have back history. So you're getting a sense of the average positioning over a time frame. Because we're using essentially, you think about it like sophisticated Monte Carlo simulation, like a Bayesian approach. What we solve for is actually today's portfolio, but in the context of the previous portfolios, but not averaging the previous portfolios. And so, our view is that gives us a much better sense of the tactical alpha positioning from these managers.
And then how often are you getting your inputs? Is just monthly data from the indices?
No, we get daily performance information, some weekly performance, and some monthly performance that we're all putting together. Taking into consideration the daily stuff is a little smaller in terms of the coverage, but very correlated. Same, with the weekly, and then the monthly is pretty much the best in class stuff. But in many ways, we're constantly getting performance information, and we're updating our views on how managers are positioned as a function of that, and then trading to when our view of that is sufficiently divergent from our held positions that it makes sense to trade.
And then how do you protect against the model shooting out like, oh, you're supposed to be short natural gas, and that explains these long short equity returns or something of that, right?
Well,
Some
part of
spurious correlation.
Yeah, part of the way that we do that is by tailoring for each hedge fund strategy to ensure that we don't,
This is the
equity long short. Right. Yeah. Equity long short managers don't trade natural gas. And so the way that we approach that is we have a defined set of exposures tailored for each hedge fund style, which is reflective of the type of exposures they have on. And in that process, we use what we call a parsimonious but comprehensive set, meaning we're not going to try and over optimize our process to any specific subset. What we're trying to do is say, here is the largest scope of different possible positions that are within the scope that they normally trade, in order to come up with the positions.
I think you should have named it parsimonious ETFs instead of
Parsimonious ETF. That would be hard to say.
And then, so it started with what was your first one? Just the hedge fund replication?
Yeah. Our first ETF, we basically built the technology, which is 7 underlying sub-strategies individually created. And our first ETF, we basically put those 7 strategies together into one ETF, a multi-strategy. And we our goal was to match the index, performance with lower fees. And so it's sort of run at bond volatility, and it's consistent with the index. And so it's done what it's supposed to do, which is track the hedge fund industry returns. It's just it didn't really blow anyone out of the water. And when we talked to a lot of advisors, they basically said, look, we like the strategies, we like the diversification, we see that you can do what you're saying you can do because you've shown it for the last few years. Is there any way to either break out the individual strategies or turn up the expected return so that it's a little more cash efficient? You have a little less line item risk in the portfolio, and it sort of can pair with equities more effectively. And so that's really what our three.
Oh, yeah.
Right. And that's really what our strategies are that we've launched. We've taken the same exact decision rules, technology, the same thing we've been running for 3 years that's worked, and we're just breaking out the individual sub strategies and then targeting a 2x target return in our newest products that we've launched this year.
That's funny to me, right? The advisor's like, wait, I had no idea hedge funds are so boring. You're like,
yeah,
they're just. That's what I think that's a lot of money and they chug along.
Yeah. And if you're an institutional allocator with the mandates that you have, you're not really looking for something that has equity-like risk because it's inconsistent with your mandate. I think for a lot of retail-oriented advisors, meaning like people who have less than $50 million or something like that, they're not trying to. Cash plus 200 would be disappointing to their clientele over time. And so, they want return streams that are complementary to things like equity index risk. And so that's what we've built.
Yeah. And also you kind of doubled down on your fee discussion there, right? Because now you're getting 2x. For the
yeah, don't tell our backers, our financial backers, but yes, by launching it at 2x, I essentially cut the cost in half. And overall, just for context, like it basically takes, you're getting 2x the target return of a traditional hedge fund exposure. And instead of 400 basis points of fees, you're paying 95 basis points of management fees. And so that's about an eighth the fees. And then, of course, in the ETF wrapper for taxable investors, it ends up being roughly half the taxes.
Ooh. I have that argument with people all the time. I'm like, well, your fee as a function of your volatility is extremely high. Like here you are compared with all these other managers in our portfolio and you're 10x. And they're like, well, you can 4x our returns. I'm like, yeah, but I'm 4xing the fee as well.
Right.
So kudos to you for doing that. What, you have a favorite of them all, or they're just doing what they do? Like picking.
It's like asking, asking what your favorite kid is. The reality is, every parent does have a favorite kid.
Yeah.
They just don't talk about it, or at least they don't talk about it to the kid's face. For us, I think we've found the most resonance with advisors most resonated with the global macro strategy. I think because it pairs nicely in a traditional 60-40 portfolio. It's got some of the defensive if you look back through time, macro managers have shown some of the defensive properties of things like managed futures because they can trade short. Like in 2022, they could trade short stocks and bonds, and traded that period quite well, in the same way managed futures did. In an environment of good performance in risky assets, it's still a diversifying strategy in positive risk asset markets. And so that's kind of that's the one that most people have liked. Some other people find the equity long short strategy compelling too, because it's equity like returns are better with lower volatility. So it's more of an equity replacement than it is sort of an absolute return strategy. And then, of course, you mentioned managed futures, but we have managed futures at 2x, which in some ways, folks have found compelling because it reduces the line item risk of managed futures. Right, that's the challenge with it. Is you have to, if you just match the index, you basically have something that you have to put a lot of capital to get the juice out of it. And so we're basically saying, well, you can put half the capital and reduce the line item risk on it.
How do you think advisors are coming along to these concepts? It's been, right, you mentioned Corey Hofstein. He's pushing this like, hey, we're creating these products that already have this built in. Leverage is a scary word, but we're not borrowing money. We're just using.
We do higher target return. We don't do leverage. We do higher target return.
There you go. Right. But it makes way more sense of like, then you don't have to put as much of you don't have to sell down as much equity. You don't have to do, right. It makes their lives much easier, but it seems, they're slowly getting there.
Yeah, I think
there was a question in there, but yeah.
No, I even in the few years that I've been doing it, and someone like Andrew's been doing this for a long time.
Yeah.
In some ways, he's like the, he's the OG in this space. That's for sure. I see a increasingly rapid recognition that these strategies make sense, particularly in the ETF wrapper. Folks are really starting to kind of accept that as like somewhat as a given, to say, hey, look, this is the best way to do it, and you can do it, and there's a lot of compelling reasons for why it is. Part of that, I think, is paired well with increasing push towards model portfolios, particularly from the independents who don't really necessarily want to spend money on a BlackRock model portfolio. They also they want to be differentiated from the BlackRock model portfolio. And so they've had a good, they find these strategies beneficial because it's essentially a way to create a model portfolio, add diversification, and differentiate from other advisors. So, we've seen a lot of interest there.
The wirehouses and the big custodians have seemed slower to catch up. They think they see leverage is bad. No. And you're like, no, this isn't the negative 2x NVIDIA play. This is actually smart target return. I'm gonna borrow that. Can I have that?
You can have that.
That's
yeah,
leverage.
For sure.
Yeah. What's your thoughts on the current market? The Fed, are they locked in a box? What can they do?
The broader macroeconomy story is that we're sort of late cycle. The economy was slowing very gradually, somewhat as a function of high rates eroding the strength of the economy even before the new administration. And then the new administration has implemented a number of negative growth policies related to constricting immigration and hiking tariffs, which are effectively just a tax on businesses and households. And that is, that slowed the economy in the first half. We grew at 1.8% in the first half, which is quite a bit lower than the sort of 2 to 3 that had been consistent in the few years prior. And so it's not surprising, given that slowdown, that we're seeing weakness in the labor markets, and from there, weak job growth. And the Fed has a dual mandate, but anytime, it seems increasingly that anytime there's a tension point between those two, the dual mandate, the employment and inflation, that they tilt towards, expressing concern about employment relative to worry about inflation. And so, the transition, there's a lot of noise around here, but in some ways, it's kind of the same in some ways, it's kind of the same thing that we saw last year, which is,
Yeah.
everyone sort of says that was a big political move, but like, the unemployment rate started rising. I think smart people recognized that it was probably not persistent, but if you were sitting in the Fed shoes, you saw the unemployment rate rising, you were a little worried about it. Inflation was elevated, but not extreme. And so you cut. And that's basically what we're seeing now, which is the unemployment rate's very modestly rising, but also labor market conditions are clearly soft, and inflation's up, but it's not crazy high. And so why not? Why wouldn't you sort of cut into that dynamic? And that's basically what's happening.
That's too boring. Come on, I want some like
Yeah. You want something
gonna
hot?
get rid of Powell. Yeah.
No, I mean, the thing that I think is interesting from a financial markets perspective is in the last 2 months we've really priced in a fair amount. We've priced in basically the most amount of easing that the Fed's going to deliver without conditions getting really bad. Meaning, basically all financial markets have been lifted from the decline in the discount rate. Like, I mean, it's interesting. Like, these are the sorts of times where everyone thinks themselves as a genius. They're like, I'm a genius. My assets are up. And it's like, everything's going up. But if everything's going up because everyone's recognized that the Fed's going to ease in some ways a little bit proactively, that's basically what's driving everyone's genius. The real challenge is it's hard to sustain those moves.
Yeah, after they cut, what do you do?
Right. It's hard to sustain those moves because in order to get the continued discount rate decline, you have to have essentially policy be easier than what is already priced in. And the challenge is policy that's easier than what is already priced in would require growth that is meaningfully weaker than current environment. And so if you're sitting there holding equities, you don't really want growth that's weaker than what's going on right now, right? That would be a bad outcome for you. And you would probably have more of a negative influence than any further declines in the discount rate. And so that's kind of the question, is basically like, how do you get sustained asset appreciation from here now that you've basically gotten all the sort of benefit from a dovish Fed?
Yeah. But that's literally the game we played for like dozens a year. Like, how do we keep this machine going? We'll figure out a way. Just buy. And do you like derogatorily, we'd call you a macro tourist, right? Like, you're giving all these thoughts and all that, but like you're saying it helps you inform, right? The models are doing what they do regardless of what you think, right?
Yeah. I mean, the way I'd say it is that we run our products based upon, in a systematic way, based upon our views of what the aggregate hedge fund positioning is. And in a lot of ways, I think part of what I'm doing with any personal discretionary macro views, they aren't influencing how we're running the money in those ETFs. They have two sort of primary values. One is, it is important as a portfolio manager, as part of the process of understanding whether our technology is working, is to understand what's going on in the markets, why folks would have views that they might have, and constantly be triangulating both systematically but also discretionarily, meaning talking to hedge fund managers, stuff like that, to understand whether we're capturing the essence of what's happening. And so that's part of it. The other thing is, in the same way that, tying back to the earlier conversation, that a real business benefit that Bridgewater brought to the market was giving high quality insight into what's going on in the markets to clients, to make sure, to help them sound smart, to help educate them and sound smart in the market. That's a big part of what I do on a daily basis, is going through that process. And so that starts with my own insights and commentary about what's going on. And I had a client recently who reached out and said, that my view on the economy was, let's say, more bearish than the wisdom of the macro investment community. And I said, yeah, that's right. And the wisdom of the crowd has beaten my understanding in the last few weeks. So isn't that what you want?
Yeah, But yeah, you're good at it. So I'm glad you're not just, there's a lot of these people, replicator or systematic traders are just like, I don't care what the market does. I don't need to know. And I'm like,
Right,
well,
right.
surely you have some opinion. Surely you're reading the interwebs and have a stance.
And I think part of the challenge in the replication space is there are people who approach it as a statistical exercise. And I think about some legacy replication products that are out there that, like, if you talk to the people who created them, like, they couldn't tell you that the Fed's meeting today. Like, they couldn't tell you anything, right, about what's happening in markets. And having created systematic strategies for a long time, there's a science to it. There's the sort of statistical work that's done and computer science work that's done, but there's also an art to it because you have a lot of implicit decisions that are going on. And so in a lot of ways, what I like to say is, like, we are my co-founder Bruce and I, we're basically, we have 50 years of experience having literally built systematic strategies across these funds. And we're applying that thinking and that understanding because we understand how funds actually operate, how they actually think about these things, and using that to craft a systematic approach. So it's a bit of an art and a science that, a lot of the replication stuff that's out there is mostly science and, in the worst case, lab science rather than practical reality, having done the work in the past.
Right. Like, does your global macro include foreign indices, equity indices?
Of course. Yep.
Right. So that'd be an example, right? Like, if I'm just in a lab, I'd probably just have the S&P.
Right.
Right.
And actually,
one of 20 years, like, why include anything else?
Yeah, one of the things, some of the markets that have delivered some of the best performance this year, Japan, China, which basically start talking about Chinese stocks and everyone kind of looks at you like you're a crazy person. But those are all, but those are markets that global macro managers trade. And so, and to be frank, I've traded in my career. And so, they're important components of how we think about the overall replication approach.
And to be frank, for me, are way overdue for a reversion to the mean. What kind of rabbit hole you been going down recently?
Well, one of the interesting things that I like about having a managed futures product is trading all of these markets that I wouldn't otherwise have at the top of my head. And so
and
recently
I got to give you quick props of launching a managed futures product in the midst of a historic 18-month drawdown.
That's right. That's right. Well, the best time to buy is after some pain.
Blood in the streets.
Blood in the streets. So I recently went down a rabbit hole on the live cattle market, which actually has added a fair amount of positive return both for our managed futures product as well as our global macro. It's a very interesting market. For instance, you probably don't know that the herd size today is at its lowest level since 1950, and that has created a real tight supply in the market. Or we talk about macro and the impact of tariffs, but a lot of our beef imports are from Brazil, and at a 50% tariff, that's actually a big problem. Because a lot of those costs are going up in sort of, let's call it the cheap beef that's coming into the U.S. market.
For like the fast casual burgers.
Exactly. It's coming from Brazil supply, and that's 50% tariffed, and that actually is a real problem when it comes to prices. Not to mention the Mexican screwworm, which is really caused some challenges with Mexican supply. Which
it's not a joke, people. There's an actual thing called the Mexican screwworm.
Not a joke. So anyway, this is it was a little bit. I wrote a blog piece about it recently as well. Just kind of getting into these markets that I wouldn't normally spend any time thinking about, but they're bigger. Live cattle's been sort of a march up and to the right, pretty much more than any other agricultural commodity. And so I went down the rabbit hole on live cattle.
which is an odd because grains have been going down into the right massively, right? They're at all-time lows, which you would, right? That's what the cattle are eating to fatten up. So usually those two would be more correlated. So yeah, you outed yourself though as not a avid listener of the podcast because 2 pods ago we had a guy on talking all about live cattle.
Oh, is that right? Oh my
Yeah.
gosh. Well, I should go back and listen to that. I actually I occasionally do I do a radio program called AgriTalk. Shout out to all the AgriTalk listeners out there. Now there's probably not so many, but it's the largest syndicated farm oriented show in the country in Middle America, and so I always love it because we sort of talk Main Street macro dynamics that are going on, which is helpful for folks. But I always enjoy the segments ahead of time where I'm learning about, the soybean yields in Southwest Iowa or whatever, running up into when I come on.
The basis trade's blowing out in Pierre, South Dakota.
Exactly.
The one more blog post I'll mention. We had a blog called "The Picture from Space That Proves Why Commodities Are Non-Correlated." And it's basically 10, 15 years ago, there was a snowstorm in July in Wyoming, and the cattle hadn't, maybe it was August or September, the cattle hadn't grown their winter coats yet. So like 70,000 cattle basically died, froze to death from this freak blizzard. So it's like, yeah, that kind of stuff's not priced into equity, PE ratios and all that. That's why you need
right. Right. And it's a great, live cattle, I think is great because it both, like, when you look at it, there's sort of like fundamental reasons why there's been strength in the market. But there's also, if you're a trend follower, if you're, then you've picked up this price trend that's been, running quite well. So it sort of speaks to the value of both traditional fundamental analysis, but also price trend analysis as, ways to find opportunities in markets that you otherwise wouldn't find.
And the weird thing, cure for high prices is high prices, right? Everyone will start slaughtering their cattle to grab those high prices, but that hasn't seemed to happen yet.
It has, it's happened a little bit, supplies increase, but the thing that is incredible is the insatiable demand for us, for Americans, for hamburger meat and such. And it's kind of incredible.
But watch your commercials over the next couple weeks, listeners, too. Like, you'll see McDonald's, all these chains pushing chicken. That's interesting. Like, a guy mentioned that to me, and like, I'm starting to see, and I go to McDonald's like 5 times a week just to order a Diet Coke, but it's popping up in my app and on the menu of like, order a chicken today.
That's interesting. They're trying to figure out a way to reduce supply or reduce demand, because they're probably not going to change their menu prices, are they? That's so interesting.
Last question I wrote down here, I never got to, going back a little bit. Like, you never mentioned risk parity in talking about Bridgewater, which was kind of synonymous with them in the past, and you don't have a risk parity ETF. What? Any reasons for that?
I mean, risk parity in a lot of ways is just it's a somewhat smarter way to build a passive portfolio. It's in this world, like, I think when it comes to diversification, and I talk to a lot of advisors that are out there, most of them have 60-40 or the equivalent. And when you're thinking about what are the most important ways in which you could build diversification into your portfolio, the highest bang for the buck, it's not really shifting all the way to a risk parity portfolio. It's really doing simple things like maybe you add some gold into your portfolio, or adding long short strategies, like tactical long short strategies at a reasonable fee. Those are the sorts of things that will move the needle for advisors. And risk parity is a fine theoretical concept, but it's not.
Yeah. I think one of the first replication ETFs, right? RPAR or something.
Yeah, that's right. That's right.
Didn't do very well from my recollection.
It's just there's a challenge with the distance between that strategy and where most advisors benchmark themselves, and that's line item risk or pure risk is a practical reality that exists for any manager, and you're better off recognizing that that's the reality than trying to think that it doesn't exist.
Love it. Get yourself some managed futures and global macro instead.
Exactly.
Awesome. I think we'll leave it there. Got any other thoughts? Leave us with?
No. Thanks so much for having me. It was great to catch up.
Agreed. Next time I'll try and find you at Future Proof. We missed each other, but there's 5,000 people running around. And we'll look you up next time we're in New York.
Yeah, for sure. It was great chatting, and let's definitely do it again sometime.
Awesome. Love it, Bob. Thanks.
Talk to you later.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.